Welcome everyone to our latest webinar in our Capital Insights series. Thank you for joining us today. This series is meant to provide information and have a discussion on topics related to funding your innovation startup, to help entrepreneurs expand and scale their business. Today's session focuses on choosing your financing instrument. I'm Petra Stegman, the Senior Director at Connect, where I lead our Springboard program. Connect is a nonprofit organization created some 30 years ago. Since then, we continue to work with life science and high-tech entrepreneurs to help them grow and scale their companies through the various programs we offer. We have an incredible panel lined up today, so let's get started. It gives me great pleasure to introduce today's moderator, Amit Singh. Amit leads the West Coast corporate practice at Dentons, the world's largest law firm. Over the last 25 years, he has led hundreds of venture capital and mergers and acquisitions transactions involving tech and life sciences companies. He received his JD from the College of the Law at UC San Francisco and his LLM at NYU Law School. Amit is also a frequent speaker and author on startups, venture capital, and mergers and acquisitions. Welcome, Amit.
Thanks, Petra. Thanks, everybody, for having me. So why don't we get into it? If Petra, if everybody can all the speakers can add themselves to the session, and then we can do quick introductions. We've got Kate Dilligan from Cooler Heads, Bijan Moallemi from Mosaic Tech, and Tim Hoerr from Serra Ventures. Kate, would you mind please giving us kind of a quick background on your history and experience, and then we'll move on to the other panelists?
Absolutely. So I founded Cooler Heads Care in 2018, and what we're doing is using technology to build the evidence-based products, content, and services that cancer patients need to manage the often daunting side effects of treatment. This comes from my background as a cancer patient. I went through treatment in 2016 and identified that there's a huge disparity between the care you get from your medical team, but managing side effects is really overwhelming. But before that, I was working in tech and have an MBA from Stanford.
Thanks, Kate. Tim, would you mind giving everybody your background?
Sure. 3 phases to my career. I guess I'm the old guy here. 15 years in public accounting on the management consulting side, both in the Midwest and then in San Diego. And then roughly 12 years as an entrepreneur with 3 different companies, a couple of them acquired. And then around the sort of the end of the decade, 2009, started Serra Ventures, initially as a consultancy, working with high-tech companies on capital formation, strategy, and commercialization of tech, and then launched a venture fund in 2010, which has now turned into a series of funds. So we are quite involved in all things tech, typically coming in a seed to Series A stage company. We have several companies on the West Coast, several in San Diego, and then many spread throughout the country.
Thanks, Tim. Bijan?
Thanks. So I'm the CEO and co-founder of Mosaic. We're a financial planning software for small and medium-sized businesses. So really automating a lot of those more strategic workflows that CFOs are responsible for. Company today, we were founded in 2019. Most recently did our Series C fundraise a couple months ago. Company's around 100 people today. Prior to starting Mosaic, really my entire life was actually being a practitioner on the finance side. Spent 6 years building and scaling the finance organization at Palantir. And prior to that, started my career down here in San Diego doing FP&A at Qualcomm.
Thanks, Bijan. Well, why don't we jump in? Tim, since you're a VC, you can look at things from the investor lens. Do you mind giving the audience a high-level overview of the common funding instruments, safes, convertible notes, and preferred stock, and how you look at them from the investor perspective?
Sure. Let's take those maybe in reverse. I think investors love to ultimately get to a preferred equity round, or otherwise called a preferred stock round. That's really the business we're in, is to come in and have an equity position in a company. And I think that's ultimately what startups company would like to get to. So a preferred stock round is simply, again, it's an equity stake in the company as opposed to debt. And we're becoming co-owners along with the founders. This distinguishing factor there on a preferred round is that the preferred stock differentiates itself from common stock of the founders in that it has certain preferences attached to it. And we won't elaborate on all of those today, but certainly happy to answer some questions on that. The most common preferences end up being a board seat, some protective provisions where we can influence decision-making even though we don't have a majority interest, liquidation preferences so that when the company does ultimately have an exit event, there's a priority that's given to the preferreds. Sometimes there's dividends and the like. So that's why, it's called a preferred round. So that's sort of the overview there. Another instrument is called a SAFE, which is a simple agreement for future equity. And as it implies, it's an agreement that parties enter into contemplating ultimately that instrument will convert into preferred equity. So a SAFE is often used, say, in between rounds, maybe if the company isn't completely satisfied with the metrics that it's achieved and they'd like to, they don't want to do a preferred round where the valuation on the company is set. They can defer that decision, so to speak, by doing a SAFE where the parties agree, okay, we'll take your money now under certain conditions, and it will ultimately convert into preferred equity in the company. It's often used as well in a very early stages of a company. And then finally, maybe let's chat a bit about convertible notes, which are probably the third most common instrument that we see. And a convertible note actually is a debt instrument. So it is first and foremost a note that is a piece of debt, and that it ultimately anticipates converting into equity. So it's similar to the SAFE, although the SAFE is not. The SAFE's actually not equity or debt. It acts more like equity, whereas a note acts more like debt until it converts into equity. And again, convertible notes are used very, very similar sorts of situations that a SAFE might be used. And maybe later on in the conversation, we can distinguish between some of the feature sets of a note versus a SAFE. There are some less common. There's some revenue-based financing where a company enters into an agreement to take on some funding in exchange for giving back to the funder a % of their sales. That's maybe a little more common later on down the road when the company has an established commercial product. And then there's conventional debt, which often isn't available to a very early stage companies because banks are relatively conservative, right? And they want a company that's ultimately profitable and has a sufficient asset base, which often very, very early stage companies don't have. But that's sort of the bird's eye view, I think, of the most common instruments available.
Thanks, Tim. Kate, I know you've raised several rounds of financing and recently raised over $8 million. One of your earlier rounds was a SAFE. When you were deciding on the instrument for the various rounds, what was your thinking behind that in your ultimate decision?
Yeah, so we did 2 convertible notes, and then, very similar to what Tim was saying, before we were ready to do our price round, which we just closed, we did open up a SAFE because a SAFE was developed by Y Combinator, which a lot of entrepreneurs know a lot about, which is a very high profile accelerator in the Bay Area. And convertible notes and SAFEs have the real benefit for startups of being incredibly inexpensive to do. Our equity round cost us a lot of money. It is not uncommon, even if you're, a late seed stage company which we are, without disclosing numbers, and, you can easily spend 6 figures on an equity round. And so for us, we wanted to do convertible notes and then a SAFE because we were trying to be as capital efficient as possible as we were focused on getting our product to market. So it was also, what the market would bear. So, our first product is a medical device cleared by the FDA. And so med device investors have a high degree of comfort with convertible notes. It's a very vanilla, I would imagine you would say, Tim, instrument, and then you negotiate on what the pre-money, or the post-money valuation is and what the discount is. And so really coming to an agreement that you as the founder or the founding team can feel comfortable with, but can get, a handshake, with a term sheet from your lead investors on those rounds. So for us, it was really, our goal was to get to this point, to get to an equity round, but it was just, we didn't want to spend the money early on. So we made the decision to put the money into our intellectual property, as we're paying, big law firm bills rather than, the corporate side.
Kate, when you were talking about pre-money versus post-money, can you describe for the audience a little bit about the difference between the two and the effect it can have on your cap table?
Yeah, so basically what you're doing is you're negotiating what the value of the company will be, and will be, in the future. So a convertible note is as Tim said, it's a debt instrument that will convert to equity that will eventually convert to equity. That is the goal of this. And what you're doing with the convertible note is you're telling those investors, with the valuation of the note, and if there's perhaps a discount, what their economic benefit is based off of, the future value of the company. They're going to come in at a significant discount because they're putting in money earlier when it is riskier. So it's a way for the founding team to incentivize early stage investors with something where they know what it will be, where it tends to be with a SAFE. You can put valuations in there, but normally a SAFE it'll just be converting at equity at the next round. Sometimes there's a discount, depends how it's structured. But for example, for us, for our last SAFE, we just said it's going to convert at the same round as equity. And we had investors that were willing to participate in that. And that turned out to be a huge benefit for us.
Well, you're quite lucky that you didn't need any kind of discount or cap. One thing I want to mention is the post money versus pre money calculation can be quite important.
Absolutely.
On the SAFE, the post money valuation, if you invest $1 million at a post money valuation of 10 million, that no matter how much money is raised before the next round that causes the conversion, you'll represent 10% of the cap table. And that's something that entrepreneurs need to think about, because if you took it to the extreme and you raised $10 million at a $10 million post-money valuation, the founding team would have nothing
Exactly.
before the new money comes in. So you really have to think about that in the calculation. Okay, well, that's helpful. Bijan, I know that you recently raised a $26 million round. I think it was a Series C. Yep. When you were raising your money, how did you assess which funding instrument to choose based on your company's stage of development? Or was it really just, at this point, it's going to be preferred stock? Nobody's thinking about SAFEs or convertible notes in the later rounds.
Yeah, great question. So we have raised off of SAFEs in the past. I think as Tim was mentioning, it's typically more common at the earlier stage. And so for us, when we were thinking about raising now, I'd say it's a combination of the stage of the business that we're at, as well as just market conditions. For us, we were in a good position for the fundraise because we still had plenty of capital on the balance sheet. And that just puts you in a position where you have more negotiating power when working with investors. I think the other thing just to keep in mind is it's definitely a investor's market right now versus a couple of years ago where it was clearly a company-driven market. And so I think, as Tim mentioned, the preferred choice for investors, and in this case for us, was to do an equity round. And so the decision there was pretty straightforward that we wanted to do a preferred priced round there. There were definitely a few other considerations for us. I think first and foremost, the round had to be clean. Hearing about a lot of deals these days that have some sort of structure in them. something that might make it harder to raise a future funding round. And that was something that we just weren't interested in, again, given that we had negotiating leverage. And again, in prior rounds, we had done safes. Sometimes also see them done kind of between major series rounds, so between the C and the D, as a way to infuse the business with capital, grow faster, or potentially even build momentum towards getting to that next round. If you can fill in a portion of the Series D with the safe that's got a discount, which would be just an incentive to the next round, that I've also seen that done quite effectively in the past as well. But for us, just that primary equity round was what we landed on for the Series C.
Oh, that makes sense. Thanks, Bijan. Tim, when you're looking at safes for convertible notes, what are kind of the pros and cons from the investor perspective of choosing between the two?
Yeah, that's a great question. As I noted, first off, the note, convertible note, it's a debt instrument. It would probably tend to be favored by investors because a piece of debt is going to have more seniority in a bad liquidation scenario. If the company doesn't quite get to the level it aspires to, and we have to do more of a forced liquidation, the debt instrument has a bit of a bonus for the investors because it sits on top of all of the equity, the preferred equity and the common equity. It also typically bears an interest rate of 5 or 6 or 8%, right? So there's some accruing additional value to the investor as opposed to not. A safe generally does not have an interest rate. A safe is effectively equity, even though it's in anticipation of future equity. It's not a piece of debt. So from that perspective, safe's a little bit more of a company-friendly, entrepreneur-friendly instrument. But both of them are relatively similar in terms of feature sets that can be added into them, whether that be valuation caps or the definition of what is a qualified round at which the instrument ultimately converts. There can be things like default value. If a qualified financing round is never done in the future, either both the convertible note or the safe can be convert into the company on a forced basis at a punitive number. So from that standpoint, that they have a fair amount of similarity. But both instruments are company friendly in that, to Kate's point, they're relatively inexpensive to put together from a legal cost, and the process moves more quickly because there are fewer items to really be negotiating than, say, the priced round that Bijan was talking about.
Tim, do you ever, when you're thinking about the two, do you ever think about, well, depending on the company, most companies in the early stages, especially these, tech and life sciences companies, they don't have a lot of assets. And so the outcome is typically binary. Either you're going to do really well or you're going to lose 100% of your money. And often the convertible note, the seniority doesn't have that much value because, again, there's not going to be any money left. And so the real value to the investor isn't the liquidation preference that they have over any equity, but it's that control that they have at that maturity date where they say, okay, obviously you don't have the money to pay us. Now we can renegotiate things and maybe, get some additional equity, things like that. Is that part of the thinking that goes into it?
Yeah, I think that's fair. And a decade ago when our firm started out, in business, actually it was 13 years ago or whatever, safes really didn't exist. As Kate pointed out, it was essentially an invention of Y Combinator, and it's become more ubiquitous. And I would say more often than not, if we aren't doing a priced round, we are doing a safe. I'd say convertible notes are more and more uncommon. But to your point, using a convertible note puts a little more leverage into the hands of the investor to negotiate, a some type of a future if things again haven't maybe gone as well as we all had hoped.
And obviously there's tax differences between the two. So the convertible note, the holding period for qualified small business stock, and I'll mention what that is, doesn't start until you convert, versus a safe, arguably it starts immediately. And just for the audience, qualified small business stock, if you invest in an early stage company and you hold the stock for 5 years from the date of the investment, then you pay 0 federal income tax or 10 times, or you can exclude $10 million or 10 times your investment from federal income tax. So it's quite compelling. And when you're thinking from the company perspective, it's something maybe you can mention to the investors that that might be beneficial to them to be able to start the holding period early if you can convince them that the upside is the more likely scenario, or again, that the downside is 100% regardless. And
one more point on that is that's a great point, and we are very, very focused on QSBS as a fund. Everybody wants to get to that 5-year period where it's not where the federal and state tax, depending on the state that you're in, go away under the parameters you describe. I guess the other thing on a note is that it is accruing interest, and that is taxable to the fund. So if I've given you a note instrument and it's accruing, it's on paper, and I'm having to pay tax. If there's never interest paid, ultimately I can deal with the write-off. But in the meantime, I'm having to pay tax. So that's another bit of an argument in the favor of an entrepreneur and an investor agreeing to do the SAFE as opposed to the convertible note.
Bijan and Kate, Bijan first, please. Now that you've done several funding rounds, what are the things you'd think about with 2020 hindsight? What are the things you'd think about if you were to do it again in deciding between or among these different instruments that you could take, and also the terms that go into them?
Yeah, so I want to caveat this by saying that these are just my personal thoughts, and I think it's probably going to be unique to each entrepreneur. But hindsight would be great. I think what comes to mind for me is those early rounds are the most dilutive rounds. And so my bias, at least for me, if I were to start another company, would be raise the least amount of possible early on, try to get as far as you can, because those early rounds are just much more dilutive than later stage rounds. I think second one, and this is definitely true in today's conditions versus 2 years ago when we raised our Series B, you should just go in expecting that the fundraise is going to take a lot of your time as well as your team's time. And again, we kind of touched on the point that this is a investor's market, and Tim, I'd love to get your perspective, but investors, at least how I think about it, are looking for reasons not to do deals. They're going to be doing less than before. There's a lot more scrutiny. There's a lot more diligence. So you should be expecting to put in more time. It's going to take probably longer, especially if you've done a prior raise. And you also got to be comfortable with no's. And so that means being willing to ask for feedback. What landed, what didn't land, what didn't resonate on the pitch. What are the things, the fundamentals about the business that they would want to see that they don't yet see? And then also just be willing to put in a lot of hard work behind the scenes, prepping, practicing, reworking pitch decks, and just know that you ultimately only need one yes. I think the last thing that comes to mind for me is you really want to be thinking one fundraise ahead. So if you're raising a Series B, the important thing to be thinking about is, okay, how much capital does this give me? And where do I need to get the business to in order to have a successful Series C from a valuation perspective that I would be happy with, as well as my investors? I think you're seeing many examples now where companies have raised a couple years ago, not really understanding the goalposts that it might take. And now that market conditions have changed, multiples have come down, a lot of companies probably don't have the capital to get that next round done in a way that they or their investors are going to be happy with. So I know that was a lot, but those are kind of the first few things that come to me.
No, that's right. And you mentioned dilution and how dilutive the early rounds of financing can be. Does that go into the consideration of the instrument you want to choose? Because as you know, safes and convertible notes are effectively locked in potentially at a percentage of the company, or at least they know there's a cap on how much the valuation would be on the next round when they convert, versus if you were to raise in, let's say, Series Seed preferred stock, which is like a dumbed down version of the typical preferred stock terms, not as easy and cheap to do, to Kate's point, as a safe or convertible note, but somewhere in between. But then at least you've locked in your investors at a valuation and they get diluted by the future rounds. Is that a consideration you made when you looked at when thinking about in the early stages what instrument you use?
I would say absolutely. And again, I think it goes to my last point as well, right? Because if you're raising a note, that hasn't yet been priced. So you really need to be thinking through, okay, if this is the first round that I'm raising, you know, you're getting diluted a certain amount in the safe, but you really need to be doing that cap table math on what could a potential Series A look like, and make sure that you're factoring in the safe as well. And that's going to be quite a dilutive round when the two hit at the same time. So definitely something that we spent some time working with on our lawyers as we were doing that first round, and would highly suggest that other entrepreneurs do the same.
Thanks, Bijan. So Kate, question to you as well. With 2020 hindsight, are there things you would have thought about or differently, and would you have done things differently if you were to do it again?
Oh God, thousands of things I would do differently. And I think what's really important for early stage entrepreneurs to understand is making sure that you're targeting your investor conversations towards people that would have the stomach to participate in your particular round. So, our first product is hardware, and med device. So that is going to narrow it down to a certain population. And when I first got in, when I first decided to be an entrepreneur, really understanding the different flavors, really getting smart about, Crunchbase, and finding, a friend that's got access to PitchBook. So you understand who are the investors that are investing in things that are like what you're doing, who will have that tolerance for the stage that you're at. And I want to, echo everything that Bijan was saying about rounds taking longer. And one of the things that I think we've been doing well as an organization, like understanding, because like we went commercial a year ago, is building relationships with investors early. And so going to investors when you're not necessarily asking them for money, is simply telling them where you are in the progress that you're making, building relationships, staying in touch. We got a major distribution agreement from somebody who I'm hoping is going to come in the next round, but just kept following up and hitting those milestones and communicating that very clearly, because it is an investor's market now. And if you put in the time and effort to build a relationship, and I'm not saying you're spamming them with notes, but like if you meet with a customer that they somehow have a connection to, or you hit a particular milestone that for whatever reason, there was something that they mentioned to you about the business that's of interest to them, maintaining, like doing that work is really, really great and is going to pay off dividends, because it'll get you to what Bijan was saying, either a faster, we're really interested, or, a faster no. And fast no's can be as benefit as a fast yes. I'm sure, Tim, when you tell entrepreneurs like this just isn't a fit, we're decided to move our fund towards this direction so everybody can stop wasting their time.
Oh, that makes a lot of sense. And when you're talking about reaching out to investors, kind of maintaining that contact, in kind of the sales realm, they say you helping somebody to close the sale is you ask them for a favor, and then you start the momentum, and then you can ask for bigger asks, and then they feel more wedded to you. And then when later on, when you try to raise capital, say, Tim, hey, I see you're connected with so-and-so, this distributor, would love to, if you wouldn't mind making an introduction. And then Tim, maybe later on, if you say, hey, Tim, we got that deal. Thank you so much. We're raising our capital, our round right now. would you be interested in? And maybe Tim might feel a little more connected. Do you think there's any truth to that? And Tim, I'd love to hear your thoughts on that.
Yeah, I mean, Tim should, it's because I'm the on to the investor.
Well, yeah, I think there is, right? I mean, investors are human beings, right? And as opposed to robots. So I think, you know, maintaining organic connections of the like that you've just described there, I think it makes sense. You know, and we're managing, you know, on a typical week, I might see 20 to 25 inbound deals to start, right? Those are sort of the de novo deals that we're seeing. So over the course of a year, you know, that's adding up to 1,000 some odd deals. The ones that maybe have resonated somewhere along the way, that you maybe have done a bit of diligence, or you did a couple of steps as opposed to just the immediate rejection. You absolutely, as an investor, want to be kept, you know, in the loop, kept up to speed, and you know, again, whether, you know, whatever technique you might want to use, I think the basic idea of staying in touch and keeping an investor updated makes a heck of a lot of sense. So.
Just one thing I want to just dovetail one other thing on what Bijan was saying earlier in terms of getting comfortable with no. It's not taking it personally, but being able to still maintain a relationship with people who have said no, especially if they're giving you feedback, because I've turned no's in earlier rounds to investment. And so you have to, you know, check your ego at the door, and really it's a business arrangement, right? They're saying your business isn't yet at a stage where I'm comfortable with it. But if you're the entrepreneur and you can demonstrate that sort of dogged perseverance, being like, hey, you know, the baby was a little ugly when I talked to you 15 months ago, but look at where we are in terms of our, you know, whether it's regulatory or commercialization or what have you, then it's a different conversation. And I've had investors be very positively inclined towards those sorts of conversations.
Oh, that's a great tip. So Tim, if you could maybe give the audience an idea of special purpose vehicles, what are they from a company perspective? Not the ones that funds set up, but what is an SPV from a company perspective, and when should a company think about putting one together?
Sure. Yeah, so special purpose vehicle, just a fancy name for formation of an entity where you want to aggregate multiple individual investors into one singularity. And so, you know, they're commonly used if you have a number of, say, high net worth individuals, angel investors, as it were, that maybe want to invest, but you don't want 10 or 15 or 20 individuals coming on to your cap table. An SPV is a nice way that all of those folks can be aggregated into one entity, and then that entity becomes the investor, as it were, into your entity. So, you know, we've seen this commonly with, say, angel groups, where instead of multiple individuals from the angel group investing in a company, and then each of them owning individual shares, they'll come together as a group, form an SPV, it's typically in the form of an LLC, but not always. And then that one entity will come on. And so it makes it simpler, I think, for everybody around the company and the investor group. That way there's one point of contact with the company that can be the conduit of the information back to that group over time. So it's a simplification mechanism, and we love to see them in use in a variety of situations. So.
And at what point, I know one benefit people say is because there's only one line on the cap table, so you don't have 100 people invested in your company, and then your cap table looks more complicated and you have all these unknown people on the cap table. At what point, kind of what number would you say it starts to make sense that, hey, we're going to raise money from angels in your example? At what point does it make sense to say, okay, let's put an SPV together and aggregate everybody onto the SPV? Is it 10? Is it 20? Is it, you know, what number kind of makes sense?
I'll let maybe, you know, Kate or Bijan give their opinion. In my view, the less people on a cap table in almost every situation, the better. And I've experienced this as an entrepreneur in the 3 companies that I was, the CEO of for a 10, 12-year period of time. And I see it as the investor. It's better to have a simpler cap table with less line items and less investors, because it's more complicated to deal with more. So in my book, probably the number's 2 or 3, practically speaking. And SPV obviously takes some legal fees and such. So, 6 to 10 is maybe the magic number, but I think from the company's perspective, you want it simpler, right? I mean, all of us are benefited by that, I think. Kate, Bijan, I don't know if you have a differing opinion on that.
I don't have a specific view on the number. We haven't actually done this ourselves, but I think your theme of simple and less is better definitely resonates. At Palantir, where I led the finance org previous to starting Mosaic, that was a late stage company. We went through Series K fundraise, and a lot of time was spent just keeping communications up with investors. Anytime you need things to get approved by folks who have different requirements, things can get kind of messy and tedious quickly. So definitely have taken that to heart and tried to keep things as clean, as simple as possible through the Series C here at Mosaic, having just seen that it can become just a lot of overhead and stopping you from actually building your business the more complex it becomes.
So Kate, you mentioned that the market conditions aren't the same, and I think Bijan mentioned it as well, that obviously, and everybody knows it, that capital raising is just more difficult now, and so the terms are getting more investor aggressive, investor favorable. What are the things you're thinking about when you're, if you were capital raising now, given the market now, and the things you would negotiate and focus on? What do you think are kind of the key points you're seeing in negotiations in the market and how tough it is? What are things you'd focus on?
Yeah, so I'm a solo founder. And so for me, what is top of mind is maintaining a board seat for myself and maintaining enough, and for me, being able to maintaining enough equity so I can maintain control of the company, and figuring out with investors. And I'm really fortunate. I've had really just great lead investors that are true collaborators. But figuring out, what works for them to make sure that, they feel like, to what Tim was saying earlier, that they have input into the operations of the organization and they get that transparency. But that it's still something that I'm very comfortable leading, and I'm not doing it with, investors, threatening to come for my head. I mean, another reason to build long-term relationships with investors is so you've got a good relationship with somebody that you can call when things don't go great. Everybody's startup, there's a problem, something happens. And it really is a 7 to 10 year long relationship. And I've seen other founders really get sideways with investors that have board seats, and it can get really, really ugly. So for me as a solo founder, I want to be able to maintain decision-making in my own organization.
Now, you make a great point about relationships and how important they are. The best advice I've ever given to any client is that if in the negotiation of your financing round, or frankly any other relationship, distribution, or even frankly a personal relationship, if there's some thing that comes up that you think, oh, this relationship may not go well, let me make sure that everything's in the contract that will protect me if they end up being a bad actor. The minute you have to pull out that contract and look at the terms, and you can't just work things out with the other party, you've already lost. The lawyer's going to win, you're going to lose. It's not going to be good. So that's important. So Bijan, what's your view on having a recent raise and the challenges? What are the kind of key terms that the investors were focused on and that were tougher to negotiate?
Yeah, so I think similar to Kate, it is going to depend on kind of what you value, right? And so for us, I think our sentiment coming into the fundraise is that time kills deals, number one, and deal's not done until money's in the bank. So as we got a few term sheets and ultimately signed one, my goal, and I was ruthless every single day, is how can I get the diligence process? How can we move as fast as possible? And so as we thought through the negotiation, we were really fortunate, the investors, owners that led the round have been great partners. They were great partners during the negotiation as well. But the first thing that we did is we got the docs. We worked with our lawyers to really go through those line by line. And we kind of pulled out the couple things that we felt very strongly about. And then the things that maybe we would have typically negotiated, we were willing to give a little bit more. And then there were things that for sure we're not going to push back on, just in the essence of being a good partner and trying to optimize on speed and press things forward as fast as possible. So I think to kind of synthesize that, I would say, what are the things that you value the most? Get those out in the open and communicate them early. And then others, be a little bit more flexible than an entrepreneur may have been a couple of years ago, when it was more of a company friendly market than it is today.
Oh, that's great advice. Tim, what advice would you give to entrepreneurs raising capital now in this environment?
Yeah, I think, well, we've been, both Kate and Bijan have referenced this. Investors are finding excuses, both legitimate and illegitimate, to hit the pause button. I know for us, from a legitimate perspective, we're looking at our current portfolio. We're deploying funding to ag tech and food tech companies out of the current fund, and deciding whether we really have any new allocations left. I think we had come into 2023 thinking X number of companies, but now, X is sort of X minus a certain number of companies, because we want enough dry powder for the companies that we have. So that's, and that's one frame of mind from a VC, but many VCs are pausing or taking longer. So my advice to entrepreneurs is, you've got to be minding the gap, as in, that's the Brits say, but in this context, look at your cash outflow and be very mindful of not only growth, revenue, which was sort of the thing to really be focusing on in earlier years, but and now you've got to focus on both growth as well as the bottom line, right? You got to be able to maintain cash, extend runway, because it's going to take longer. It's going to require more resilience. It's going to require more patience. But there are still deals being done. I mean, we have done a handful. I think we've done 5 or 6 new investments in 2023. So we are doing deals. They're being done. You have to find the right party. You have to, as we've talked about here, build relationship. Ultimately, I have to like you and you have to like me, because we're going to be getting together for quite a long time. And, I'm always up for a great story. So improve your storytelling skills, right? I mean, ultimately, that's what this is about. You're conveying, hopefully, a powerful, memorable story to the investor, and he or she is hopefully buying it, but beyond that, it's not rocket science. It is kind of chipping away at it day by day, understanding. I think we're all hoping that the tide will turn here. Frankly, yeah, this is a great environment, so to speak, for investors, but I'd rather have it be a bit more of a two-way street, to be honest.
That's helpful. In the chat, there's a question. What advice do you have concerning diligence data rooms? Kate or Bijan, do you have any thoughts on diligence data rooms?
Yeah, so I'd say there's kind of 2 flavors, right? There's chatting with an investor and you get to kind of the state of the conversation prior to a term sheet, where they want to start seeing numbers and details about the business. And then there's the legal diligence, which is post-term sheet, where you're sending over contracts and all that. So I think for both, having your ducks in a row and having the house clean goes a long way, especially optimizing on speed. And then I guess as it relates to maybe like the data side of diligence, being able to speak to those numbers, right? You don't want to just be throwing numbers over a wall. So I will typically be walking investors through a lot of those numbers and making sure they understand how to interpret them for our business. And then I think it's fair to expect that investors will have net new requests. And so being able to kind of add to that arsenal and project strength by being able to turn around diligence requests quickly, at least from my perspective, has been advantageous in the fundraisers that we've done.
Yeah, I think that is absolutely spot on. And having a link that you can send to, whether it's Dropbox or whatever DocSend or whatever tool you're using that says, okay, well, we'd really like to see a data room. So we had an initial data room, and as well as, a real deep dive one that had, all the guts of everything that they would want to see. And exactly, like this is your job. And so, I would be communicating very clearly with investors, about if I had travel or something that was going to make an email potentially sit for a couple of hours, because I tried to turn everything around with a real sense of urgency, because that gets reflected back to them and they're like, okay, like they want to get this done.
Yeah, and one thing that's really important with data rooms that I think some people don't grasp is that you don't want to put anything in the data room that hasn't been screened by your, whoever is representing your legal team. What you should do ideally is, before you're into deep discussions and get your diligence request list from the investors, you should have your lawyer send you a due diligence request list, organize a data room based on that, and then have them go through that data room, because you don't want something in that data room that is going to be a surprise to even your lawyers. Everything should be pre-screened, and because if there's something that needs cleaning up, you want to clean it up before you put it in the data room if you can. You don't want to have a bunch of issues, because if there are issues that haven't been fixed, then the investors, and Tim, love to hear your thoughts on this. The investors might think, well, what else? We've discovered this is an issue. What else have they not been doing good housekeeping on?
Yeah, I think that's a great point. We were just discussing this this week. We had a situation where we had a question come up. This company that's going through an exit process, and a couple of agreements had been put in place that were germane ultimately to the exit process. Some funds that were flowing not to investors but to other parties, and those documents hadn't been included in the data room when we did our initial diligence. And so from my standpoint, and I believe from legal standpoint, and Kate, you kind of your terminology was all the guts, and there's no reason to be withholding anything. Where ultimately, when you're into that deeper dive version of the data room, might be a reason to withhold in a more preliminary level if the VC is just getting to know you. But if the VC and your company are in negotiation on terms, and they're requesting, a deep dive data room, you better as well put everything there, because it's only going to cause problems down the road if you don't.
Yeah, I would very much agree with that. No surprises. And Tim, I think you touched on something that in this environment, I think is also important, which is, I think it's acceptable to have different levels of data rooms. Like investors, to move the process along, may ask to see decks or materials early. And in this environment where you're going to be getting a lot of no's, you as an entrepreneur should feel comfortable not sharing the guts of the business at that point, knowing
Absolutely.
that someone could share that information easily. But as you get into the later stages, being an open book, being a fair partner is extremely important.
Yeah, no, that's great advice.
Just agree with absolutely what you just said there, Bijan. No problem, having a condensed higher level room that doesn't have everything in, when the VC is going through that initial evaluation.
So, Tim, I know that a lot of times people say, well, let's use the Y Combinator safe because we can just sign it, don't have to negotiate it, et cetera. what's been your experience as far as how much negotiation there is? Like, should a qualified financing have some kind of minimum? Should there, should it be a pre-money and rather than the off-the-shelf post-money valuation? How much negotiations have you seen with respect to safes?
Yeah, well, or earlier on, in the more frothy era, call it, let's just say 2020 through early 22, there wasn't a heck of a lot of negotiating going on. I mean, the power base was really in the hands of the entrepreneur. But I just recently did a safe with a new company, and we did have a fair amount of back and forth, specifically on the maturity date, where was the appropriate time to be placing that? Was it at 2 years or 3 years? We negotiated the valuation cap. We negotiated actually a liquidation multiple if the company would be sold prior to the maturity date. And that actually escalated. So we had a clause where it went up the longer the safe kind of hung around, as a bit of a penalty and more of an incentive to get the dang round done. So in this particular case, yeah, we had quite a bit of back and forth. And then we ultimately did have a default value. Hey, if you get to the 3-year maturity date and you haven't done a qualified round of 3 million, then you have a default value that we at our option can convert into. And again, we went back and forth, and I think we had a couple things in there that were viewed as too punitive, and we came back off of those. But yeah, it was a bit of a sword fight. A bit surprising given what safes were over a year ago.
Yeah. And Kate, did you see any negotiations in connection with your safe, or was it just sort of off the shelf? Sounded like yours was the no cap, sort of everybody's kind of signed things without negotiating anything. Or maybe was that friends and family?
It was high net worth individuals I've built a very strong working relationships with, who were like, because, the round, to what Bijan was saying, was taking a lot longer. And so I'm very fortunate that I had investors who said, you know what, we want to make sure the trains keep running on time. So yeah, I lucked out, and I'm very fortunate.
So Bijan, I assume that the documents for your C round were kind of based on the National Venture Capital Association documents these days. Most venture rounds are based on. Were you finding that there was a lot of negotiation off of the sort of standard terms in those, or were you seeing that people are generally probably maybe more investor favorable terms out of those, but not going too far out of the box as far as what the terms ultimately were?
Pretty standard and within the box. And I guess in terms of advice, one more thing comes to mind, which is we asked to hold the pen on the docs, which meant we could take the docs from the B and really just make minor tweaks to the C, rather than kind of starting from a different set of paperwork, which just makes the whole process easier. And then it's more obvious where folks are trying to push back on, and also gives you as an entrepreneur a position of strength, which is, hey, I've already negotiated XYZ term with the Series A and B investors. Like, can you play ball on this one? It's easier to have those conversations. So I think having control of the docs and working off of the B paperwork as a starting point really allowed us to move as quickly as we did.
That's a good point. And I would say that in general, it is company counsel that takes the docs, the form docs, and negotiates off. Everybody negotiates off of those. And it is, if you're doing a C round, you start with a B round in docs, unless there were something totally different than market. And it is easier to negotiate, but it's also something to think about when you're negotiating your B round and somebody asks for something unusual. You know that the people in the C round are going to want the same thing. And part of the negotiation obviously is, do they get that, and how much pushback you give to them, because you are afraid you're going to have to give that same crazy anti-dilution or whatever it is, the term that they're asking for. But you can also in that negotiation say to that investor asking for something like that, if we give this to you now, you know that the next investor is going to want the same thing. We will be more closely aligned at that time. Do you really want that to be the case? And I think in some cases, the answer should be no, that no, actually, we don't want to have to give that to somebody else. And so, but maybe there's a side letter or something where they try to sneak it in on the side, but in general, that can be helpful in negotiations. There's a question in the chat by TJ Cooley. Can SPVs be used with safes, and can multiple SPVs contribute to a single round? So Tim, since you're our SPV expert, I wonder if you can hop in on that.
Too rich of a description, but the answer is yes and yes. Unless there's some other, something contained in the articles of incorporation that would, prohibit it. I haven't seen a case where you couldn't, ultimately use an SPV. An SPV could use a safe, and can there be, multiple SPVs in a given funding round? Absolutely. So yeah, very, very common.
Okay, and so we're kind of running to the top of the end of the hour here. Bijan, any kind of last minute advice on choosing between the different types of instruments and negotiating around?
Nothing comes to mind that we haven't already discussed, to be honest.
That's fair. Kate, same to you?
Yeah, I think, I really think that it's a really early stage founders that are gonna have a choice between, a safe and convertible note, because, everybody does want to get to equity because it's just so much easier to know exactly where everybody is.
Yeah, that's a good point. When the only time really that you see in the later rounds, a convertible note or a safe is usually more a convertible note, and it's a bridge between two rounds, and that your investors in your B round are going to invest in your C round, but you just need a little bit of money to get there, and so they'll invest, and then that money will convert in the next round at some discount, but it's usually not like a cap or something like that. Tim, any last minute advice for the folks?
I would say, tap the brilliant people around you, right? So if you have a board, formal board, or if you have a board of advisors or just some informal advisors, and your professional legal counsel and accounting counsel, don't be afraid to engage in, some hearty discussion about what should you do in this particular case. What advice would they have? So yeah, I think there's wisdom to be found in the collection of counselors that surround you.
Yeah, Tim, I think that's a really fair point. As an entrepreneur, you're negotiating against investors who do this for a living.
Right.
And it can be quite intimidating to go through those first few fundraising rounds. So lean on your lawyers, lean on your board, lean on advisors as much as possible. And there's no such thing as a bad question to those folks.
Yep, that's right.
And
Yeah, I guess
go
one
ahead.
other piece of advice I would have is, as a founder, I've had great luck diligencing investors by, even messaging on LinkedIn, founders that are part of their portfolio, and other founders are tremendously generous with their time towards other founders. If you ask for, a 10 or 15 minute call just to get feedback, is this person good to work with? Is this person not good to work with? I have found people to be more than happy to chat, and it's been very helpful in us making decisions about whose money we take.
And Kate, also with respect to those relationships and who would be good to take as an investor, were you also thinking about who's going to actually sit on your board from the funds versus is it, it's just going to be whoever they designate, and maybe that person isn't the right fit, or is that person going to deliver value in those meetings rather than just be there for the financial aspects of their fund?
I'm so glad you asked that, because yes, that's so important, is making sure that whoever's on your board actually has decision-making power. I've been very fortunate that all my board members are able to make decisions, but I've talked to other founders where, they get a junior associate who's there to be in the meetings, to take notes, to go back and ask the senior partners what they should do. And it just, to Bijan talking about just the time and energy that goes into that, it can be exhausting.
Yeah. Oh yeah, that would be awful. Bijan, when your investors were coming in, were you looking at them and thinking like, okay, is the board member going to be delivering value beyond just the money?
Definitely. I think you're going to be partnering with this individual, this firm, for a decade or longer, potentially, and you want folks with different skill sets around the table. So for our Series C, one of the things that was important to us is we want someone with operating experience. The other folks from the A and the B were always investors, which I think is a super helpful lens. But we were looking to add someone to the business that had worked inside of a company and really built a company, the stage of the company that we're at. And so we got really fortunate with the partner that we landed had that very specific experience.
Yeah, I'd probably tell the funds you'd be partnering them for 5 years, not 10 years, because they like to hear exit. They don't want to hear they're in for 10. Well, thanks so much. You guys have all been wonderful. Really appreciate your time. I think we've answered everybody's questions.
Thanks.
Thank you so much for the opportunity.
Yeah, so thank you so much. We're right on the hour. Fantastic. Thank you so much, Amit, for moderating today's session, and thank you very much, Bijan and Kate and Tim, for joining us and all the sage advice all of you shared and your journeys. Each of you really provided, some great insights and lots of good advice for other startups to keep in mind, when they move forward. Thank you, everyone, for joining us on the call today. I hope you found today's webinar insightful for the companies that you're building. This webinar is recorded and will be made available to everyone. And we hope you'll be able to join us for future sessions on Capital's Insights. Wishing all of you a wonderful day, wonderful evening, wherever you may be. Thank you so much.
Much.
Thank you. Bye-bye.
Bye-bye.